Want to keep more of your stock market profits in 2025? Discover 5 game-changing tax strategies that could save you thousands, backed by the latest IRS rules and real stats. Stay tuned to supercharge your investing.
Welcome to Strategic Ledger. Today, we're exploring essential tax strategies for investing in the U.S. stock market in 2025. Whether you're a beginner or seasoned investor, understanding these can save you thousands. We'll cover key concepts, proven tactics, the latest developments, and back it all up with statistics and references. Stick around till the end for a quick summary. Let's get started. Section 1. Understanding key tax concepts. First, let's break down the basics. When you invest in stocks, taxes hit in 2 main ways: capital gains and dividends. Capital gains are profits from selling stocks. If you hold for 1 year or less, it's short-term, taxed at ordinary income rates, up to 37% for high earners in 2025. But hold over a year and you get long-term rates, 0% for single filers with taxable income up to $48,350, 15% up to $533,400, and 20% beyond that. For joint filers, those thresholds double. Dividends are payouts from companies. Qualified dividends from U.S. stocks held at least 61 days are taxed like long-term gains, 0%, 15%, or 20%. Non-qualified, they're hit with ordinary rates up to 37%. High earners watch out for the 3.8% net investment income tax if your modified adjusted gross income exceeds $200,000 single or $250,000 joint. These rules haven't changed much from 2024 thanks to inflation adjustments by the IRS. Section 2. Strategy 1. Long-term holding for lower rates. Strategy number 1. Hold stocks long-term to unlock those preferential rates. Why? It can slash your tax bill dramatically. For example, if you're in the 37% bracket and sell a stock short-term for $10,000 profit, you pay $3,700 in taxes. Long-term, just $2,000 at 20%, a 17% savings. Statistics show this pays off. According to Investopedia, long-term holding minimizes risk and maximizes after-tax returns, with historical data indicating investors who hold for over a year see average annual returns boosted by tax efficiency. In fact, a TurboTax guide notes that most individuals pay 0% or 15% on long-term gains, covering over 85% of filers based on IRS data. And with the S&P 500 up about 15% year-to-date in 2025, locking in long-term status now could save big come tax time. Pro tip: align this with buy and hold investing. Warren Buffett swears by it. His average holding period? Forever. Section 3. Strategy 2. Tax loss harvesting. Tax loss harvesting. This is selling losing stocks to offset gains, reducing your taxable income. You can offset unlimited capital gains with losses and up to $3,000 against ordinary income per year. Excess? Carry it forward indefinitely. In Q2 2025, Parametric Portfolio Associates harvested over $5.9 billion in losses, delivering $209 million in net tax savings for clients. A Natixis report from July 2025 highlights that in volatile markets, like the tariff scares earlier this year, harvesting boosted after-tax returns by 0.5 to 1.5% annually. IRS data shows over 90% of filers reported no net capital gains in recent years, partly due to strategies like this. But beware the wash sale rule. Don't buy back the same stock within 30 days or the loss is disallowed. Automation tip? Use robo-advisors like Wealthfront, which claim their harvesting adds 1% plus to annual returns over time. Strategy 3. Leverage tax-advantaged accounts. Think 401ks, IRAs, and HSAs. In a traditional 401k or IRA, contributions reduce taxable income now, and growth is tax-deferred until withdrawal. Roth versions pay taxes up front, but withdrawals are tax-free. For 2025, contribution limits are up $23,500 for 401ks, plus $7,500 catch-up if over 50. Statistics from Fidelity show that using these accounts can cut effective tax rates on investments by 20 to 30% over a lifetime. Asset location matters too. Put high dividend stocks in tax-deferred accounts to avoid annual taxes. Merrill Lynch estimates this boosts after-tax returns by 0.5% yearly. Bonus? Charitable donations of appreciated stock deduct the full value without paying gains tax.
Section 5. More strategies and latest developments. Other quick strategies: opt for tax-efficient ETFs with low turnover to minimize distributions. Harvest gains in low-income years at 0% rates. Now, latest developments. The Tax Cuts and Jobs Act, TCJA provisions expire at the end of 2025, potentially raising rates in 2026, top ordinary to 39.6%, long-term to 20% for more people. House Republicans proposed extensions in May 2025, but nothing's final. IRS inflation adjustments for 2025 raised brackets by about 2.8%, expanding the 0% gain threshold. And with market volatility, experts like Manning and Napier recommend proactive loss harvesting now. To wrap up, long-term holding, tax loss harvesting, and smart accounts are your best bets for 2025. These can add 1 to 2% to your annual returns after taxes, compounding to huge savings over time. Remember, this isn't advice. Consult a tax pro. If you found this helpful, like, subscribe, and hit the bell for more finance tips. What's your top tax strategy? Comment below. See you next time.